Yes, PPT is visible.
Yes.
Okay. Easwar, you can start at 12:05 sharp.
Sorry?
You can start at 12:05. You can start now.
Yeah, I should. Just a second. Is my screen visible to everyone?
Yes, Easwar.
Yeah. I will start it off. So, okay, hi everyone for joining us today. So today we are going to talk about the cement sector. What is India's position globally? Why is the industry so relevant? What is the structure of the Indian cement industry? The process of cement making, their unit economics, and all those stuff. So let's just dive right into it. So if we look at India and its country-wise per capita consumption of cement, we are way below the global average. So the global average is around 500 to 550 kgs per person, and India is about 200 kgs per person. China, on the other end, uh, they consume about 1,500 kilos per person. Now, here it is also important to look at where a country is in its development cycle. US's development, it happened in the past century, post World War II boom. So their number is lower than the average, whereas countries like Vietnam, China, Korea, their development happened in the last 2, 3 decades. So they are on the higher side of the per capita consumption. In India, since the expectation is in that the next 2, 3 decades, we are going to improve our infrastructure. There's a huge headroom for this number to grow. It is just 280 kilograms. A visual way to understand this is one bag of cement is approximately 50 kgs. Hence, in India, one person consumes about 5 to 6 bags per year. And in China, the same person would consume about 30 bags annually. So, yeah, so this is per capita consumption. And if you look at the second diagram over here, we can see that cement, it forms a basic raw material for any construction, be it road, rail, houses, etc. Take this example of a 1,000 square feet house. If we exclude land, the approximate cost, construction cost of it will come around 1,200 to 1,300 rupees per square feet, which means 1,000 square feet house will be 12 to 13 lakh rupees. Cement forms 6 to 7% of this total construction cost, which comes around 1 to 1.3 lakhs approximately. So that is how relevant the product is. So let's move on to the next slide. So here are some key facts. If we see, India is the second largest cement manufacturer in the world. It is about China is 2.5 times bigger than India, but it is about 5, 6 times bigger than US, Vietnam, Iran, and all the other countries. So India is a large cement market. And cement is also one of the sectors in the country where all the top players are mostly promoter led. And another interesting fact here is that Ultratech Cement is the world's third largest cement company, ex China, that is, of course. So we see here cement is one of the sectors that faces a very less disruption risk. Now, if you see the DSLR camera, it has been disrupted by the modern camera phones. So they are able to shoot even feature films in an iPhone these days. And the support staff in various companies, they have been replaced by AI robots. And industries such as auto also face the risk of being replaced by the traditional internal combustion engine has a threat of being replaced by the electric engine. And also the traditional thermal power plant has a threat of being replaced by wind and solar capacities. So, but this is not relevant to the cement industry. As long as there is a need for housing, so housing is one of the rungs in the hierarchy of Maslow's uh, needs of a human. So as long as humans would need a roof to live in, cement will stay relevant. Let's move on to the next slide. So here we can see where the demand for cement is coming from. So around 60% is from housing, 25% of it is from urban, and 35% from rural. 27% is from infrastructure, essentially your roads, your bridges, your railways, etc. And 12% is from commercial, industrial and commercial, essentially your factories, your offices, your commercial offices, etc. So there are various drivers to this demand. For example, the urban housing demand is expected to grow at a healthy rate, owing to more people migrating to cities. So there is a report which states that 40% of India's population by by 2030, they'll be living in cities. While the rural housing demand is also expected to be buoyant, owing to scheme government of India schemes such as Pradhan Mantri Awas Yojana. So essentially, over the past 10 years, the government of India has built 5 crore houses under the scheme, and between 2025 and 2029, they are expecting to build 3 crore more. And the infrastructure segment is also projected to witness high demand owing to the government expenditure in schemes like the National Infrastructure Plan and the Pradhan Mantri Gati Shakti Plan, etc. So actually, the National Infrastructure Plan, it is anticipated that India's infrastructure will expand at about 9% per annum between 2025 and 2030. Already 42% of the projects in the national infrastructure pipeline are under implementation, and around 16, 17 more construction work has been picked up as a direct result of the government investment of about more than 1 trillion US dollars. And the PM Gati Shakti, it is essentially, it was unveiled in October 2021, if I remember correctly. It has an outlay of 100 lakh crores. This plan has attempted to coordinate and integrate the infrastructure connectivity programs of various central ministries and state ministries. Programs such as Bharat Mala, Sagar Mala, the inland waterways, the dry and the land ports, etc. So this essentially has streamlined the operation, and we can expect timely project completions and better visibility because of this, which was not the case historically. So let's move on to the next slide. So if we see, this is a supply and demand dynamics of the cement industry. Cement supply over the last 2 3 years, we see it has outpaced the demand, because of which it has caused lower utilizations among the cement mills. About it ranges between 67 to 70%, which is pretty low. And the maximum capacity has been added in the South and the East Indian markets, which is about 28% and 27% of the total capacity additions, respectively. So this has led to, as I said, this has led to lower capacity utilizations in the industry. So reason why companies have added supply in such huge quantities is because it is expected that the demand growth will be higher in the upcoming years. So the normal gestation period for a greenfield cement capacity addition is about 3 to 5 years. So the companies have anticipated demand prematurely, and they have added the capacity, hoping that the demand would pick up in the coming years. And that is what is also expected. So between FY25 to FY27, the demand is expected to grow at a compounded annual growth rate of 7.5%, while the supply addition is at a growth rate of 7.3%. So this is actually the rationale behind why the companies have added so much capacity in the last 2 3 years. Let's move on to the next slide now. So if you look at cement pricing, despite the good demand in cement over the past 2 3 years, mainly because of the infrastructure development happening in our country right now, the pricing power is still weak. We look at a 50 kg bag of cement, it used to cost 240 rupees in FY10, and now it is trading at rupees 370 rupees 370, which is up 50% over the past 15 years. It has grown at a compound annual growth rate of 3%, which is pretty low, if I'm being honest. At the same time, a single cup of tea, which used to cost rupees 5 in 2010, it is now costing rupees 20, which is up 400% over the past 15 years, a compounded annual rate of 10%. Let's move on to the next slide. So, if you, 1 minute. If you look at the trend of the cement pricing between FY between 2002 to 2012, there was a strong housing and capex boom in India. Plus, Holcim had bought out stakes in ACC and Ambuja Cement, which led to consolidation, which led hikes. So between this period, the cement prices saw a good increase. So it increased from around 150 rupees to about 300 rupees. Post that in FY 16-17, the demand environment was a little bit tepid because of various factors like demonetization, implementation of GST. In FY 18, there was Real Estate Regulation Act RERA. Yeah, although it is a very good regulation, there was a lot of uncertainty surrounding it initially. So the demand remained muted. And in FY20, there was credit tightness. FY 21-22, we all know that there was a COVID pandemic. So post 22, again, demand is being buoyant now, and there has been a lot of industry consolidation as well, which we'll see in the next upcoming slides, which gives a good outlook for the industry. Let's move on to the next slide. So this is a profit pool of the cement industry while compared to the other industries. So now around 2004, the profit of the cement industry was less than 1%. It was about was ranging between 0.5 to 1%, which was almost the decadal low at that time. And due to the good demand and good consolidation coming in, the share of the profits, the total pool of profits in the cement industry, it rose to about 3%. So again, from 3%, it decreased to 1.5%, owing to the tepid demand. And it went up again during 2021, that period, when there was a lot of investment in government infrastructure. Plus, the other industries were also facing a little bit of profit decline. So the share of cement profits went up. Now, again, its share is at decadal lows, and the consensus thought is that it has largely bottomed out and it has nowhere to go but up from here. So let's move on to the next slide. So this is essentially correlating the cement demand versus the GDP growth of our country. So if you see, cement demand has largely trended in line with the GDP growth. So between FY3 and FY12, the cement demand has grown about 1.54x to GDP growth. Between FY12 and 22, it has grown about 0.6x, owing to the tepid demand to the factors we already talked about in the previous slides. And again, post FY22, it is 1.3x of GDP growth. If you consider GDP to be growing at 6 to 7% for a country like India, we can assume cement sector will grow at a healthy 9 to 10%. And if you see the center's capex as a percentage of GDP and in absolute terms as well, has been constantly increasing over the past 2 decades. So this augurs well for the cement industry, and the continuity of the incumbent government and its policies will ensure stability and sustain investment in infrastructure. So this will be good for the cement industry. Let's move on to the next slide. So this is the cement manufacturing process. So essentially, the cement companies buy mining rights from the government, from the state governments, and they mine limestones. The limestone is fed into the raw mill, and it is essentially the diameter of the limestone is reduced, and then it is fed into the kiln and it is heated. So limestone, its formula is CaCO3, calcium carbonate, and once it heats, the carbon dioxide is released from the limestone and it forms CaO, which is essentially clinker. From here on, clinker is fed into the cement mill and it is mixed with either gypsum, fly ash, or slag, and in various proportions, depending on what kind of cement you want to make. And it is mixed and it is fed into the silo and then it is dispatched to the end user industry. So why is cement? Why is the clinker mixed with fly ash, gypsum, or slag? It is because if you look at clinker, the its setting time is around 4.5 hours, which is pretty less. So to increase the setting time, various proportions of gypsum or fly ash or slag would be mixed into the cement to increase the setting time. So that is essentially why the mixing of these materials happen. Let's move on to the next slide now. Okay, so these are the different types of cement. So there's the ordinary Portland cement, which is a legacy cement type. This was the first cement invented. Then there is Portland pozzolana cement, and there's the Portland slag cement. So the production share in India of ordinary OPC is 30%, while PPC is 60, and PSC is 8%. So OPC, if you essentially look at it, it is 95% clinker and 5% gypsum. While PPC is 65% clinker, 5% gypsum, and 30% fly ash. While PSC is 40% clinker, 5% gypsum, and 55% slag. So essentially, since clinker production is very carbon emitting, the burning of clinker is very carbon emitting. Cement industries like tend to prefer PPC and PSC in order to bring their carbon emission down. So as your cement to clinker ratio increases, the proportion of clinker you use basically in the cement decreases, and your carbon emission decreases. Both PPC and PSC are also very more denser than OPC, which means that they're stronger construction material and also have a low cost of production. If you see slag, it is resistant to very high temperature, chemical attack, and sulfate attacks. So mostly when we look at underwater construction, like bridges, etc., PSC is used. Why, even though PSC has a higher cement to clinker ratio, but its share in total production is high, is because of the it is subject to the availability of slag. Slag essentially is a very bulky material and it doesn't make sense. It is a byproduct of the steel industry and it doesn't make sense to transport it over long distances. So a type of cement where depends on the location of the grinding unit. So if it is near a steel plant, you can manufacture PSC economically. So if you look at India, most of the PSC producing capacity grinding units are located in eastern part of India, where there's a lot of iron ore deposits and a lot of steel plants are available there. So yeah, the location of the cement plant is also very conducive to what type of cement you produce. Yeah. So let's move on to the next slide. So this slide, it talks about the regional demand supply dynamics of cement. As I said, cement being a bulky product, it cannot be transported over long distances. Sorry. The cement being a bulky product, it cannot be transported over long distances. Essentially, by road, currently the share of road in cement transport is high. So by road, it doesn't economically make sense to transport cement over 300, 350 kilometers. So the industry is essentially split into 5 regions, each having its own regional dynamics. If we look at the northern region, it's a very conservative market, and it also has a very good pricing discipline. Key drivers for this market are housing, infrastructure, and also mainly metro expansion and Western DFC, direct freight corridor. If you look at the southern industry, it is very fragmented with a lot of players historically. There is a lot of price competition and very low capacity utilization. But however, things seem to be changing for the South Indian cement industry, as we'll discuss a little bit later, owing to the M&As which has happened in this particular industry in the recent past. Now, if we look at the East Indian market, it is a very high growth market, and all the top 5 players have expanded here and have almost equal market share. Demand drivers here are infra and also robust housing demand. Yeah. And if we look at the West Indian industry, it is a very low growth market, primarily Maharashtra and Gujarat. So it already is very well developed, and it had a stupendous growth till FY20. And since then it has slowed down a bit, and the utilizations have also dropped a bit. So the key demand drivers for this market are, let's say, urbanization. Slum redevelopment is a very key driver in Maharashtra, and maintenance and infrastructure are other key drivers. If we look at the central region, it is a little bit underpenetrated while in comparison to the other regions. Key drivers for this market would be rising housing demand and better infrastructure as well. So these are the regional demand and supply dynamics. Each market works in its own different way, independent of each other. Yeah, as we talked about, perennial oversupply in the South Indian market has made it very unattractive historically, and it also lacks pricing discipline. So pricing discipline is essentially the supply and demand should be in line, largely like the Western and Northern market, to ensure that the bargaining power is with it's essentially economics 101. If the supply is higher, the bargaining power rests with the buyer. And if the supply is at the lower end, the bargaining and the demand is higher, the bargaining power rests with the supplier. So yeah, South industry is a little bit notorious for that, as we'll see later. So let's move on to the next slide. So this is unit economics of cement production. So the realization per ton and the cost per ton of cement is dependent on various factors like the mix of the cement produced. So if you produce more OPC, your cost will be higher compared to PPC and PSC. And different states have different mining royalty, and different companies have different lease expiries of their limestone mines. So that also will play a huge role in how much is your cost for raw material. If you remember recently, Tamil Nadu it hiked the mining royalty for limestone, and a lot of Tamil Nadu-based cement mills had to bear the brunt of it. And if you see the cost per ton, raw material cost is about 15% of the overall cost. Power and fuel cost is 35%. Freight and logistic is 25%. Since it's a very bulky material, freight and logistic is 25% of the cost. And other costs are 25%. Cement industry is very cyclical because if you see 60% of the total cost, power and fuel cost and freight logistics is linked to crude prices. And crude prices globally, it is very cyclical owing to the demand and supply dynamics of crude. So this the 60% cost overall cost is very cyclical in cement business, which that is why cement businesses EBITDA per ton goes through periods of booms and busts. Now, if we look at power and fuel cost, it is also dependent on factors such as thermal efficiency in burning clinker. So, how much kilocalories you are consuming to efficiently burn a ton of clinker? The fuel mix, the pet coke you're using, the domestic and imported coal you're using, the alternate fuel you're using. So, this is very dynamic in uh, quarterly basis. So, if let's say the pet coke price is less than domestic coal or the imported coal, cement industries will tend to stack up on pet coke and use pet coke to burn their limestone. So it is very dynamic, and yeah, it is very cement industries are very opportunistic in how they use this fuel mix to optimize their costs. And the power efficiency in grinding a ton of cement is also very important in power and fuel costs. And the mix of thermal, green, and waste heat recovery energy is also very important. Now, if you see, okay, we'll talk about in the upcoming slide. Now, if you see the freight and logistic cost, the lead distance of cement, that is uh, how much kilometers a ton of cement travels from the manufacturing plant to the end user. That is a main factor in determining the freight and logistic cost. Let's say there are two companies. One company, its lead distance is 200 kilometers. Essentially, your plant and your end user are 200 kilometers apart. And another industry which is 300, another company which is whose lead distance is 300. Essentially, in periods of high crude prices, the company with the 200-kilometer lead distance, it will tend to have lesser costs than the other company. So the companies, all the cement companies, they want to decrease their lead distance as much as possible. So this is done by having a lot of grinding units in areas where they feel there is good demand coming up, or having a bigger cluster of units. So such impetuses make the lead distance come down for a cement company. And the mix of transportation also plays a huge role in the freight and logistics cost. Essentially, sea is the cheapest, and road is rail is the second cheapest, and road is a bit expensive. But when it comes to distances less than 300 kilometers or lesser than 300 kilometers, road is the most economical, let's say, than rail or sea. And when it comes to distances more than 300 kilometers, rail and sea is more economical. So today the mix of road is more than 90% in transport, mix of transport of cement companies. Rail is seeing good traction owing to the railway infrastructure being improved by the government. And sea is not a lot of companies are they are just testing out their sea capabilities. Ambuja Cement, since they have a captive shipping logistics company, they have a reasonably higher share of sea compared to the other places. So this is unit economics of the cement industry, per se. Let's move on to the next slide now. So if we look at the green power share of the top companies, top six companies, actually, the industry, it has started gradually for focusing more on improving their green share. So green power, it essentially cost 1/7 of the cost of power generation to thermal sources and 1/10 of grid purchase cost. If you see Ultratech in FY21, it was just 13% of its power was from green energy. And in Q2 of FY25, it has gone up to 32%. They target 85% of green power by FY30 and 100% renewable energy by FY50. Ambuja, it was its green power share was essentially nada in FY21, and now it has come up to 18%. They are targeting a share of 60% by FY30. Free cement, it used to be a pioneer in the industry, owing to having a high share of green power mix historically itself. So its green power share has gone from 48% to 55% in Q2 FY22. They are targeting 100% share by FY50. So Street Cement, they used to have an advantage in uh, costs due to the higher share of green power share. But as the other players also ramp up the green power capacity, the costs are expected to converge, and the advantage Sri Cement had is expected to erode. Let's look at the next slide. And Ramco and JK are also having the same, almost the similar targets. So this is a commentary of various managements. So if we look at the top two cement players, their comment in their commentary, they have talked about targeted cost reduction in the range of 300 to 500 rupees per ton over the next 3 to 5 years on the current base, from the current base. They are on the back of blend of investment in green power, digitization and optimizing their lead distances, higher alternate fuel mix, investing in cold blocks, and improving operating leverage among the other strategies. So Adani, if you see, they have a target of more than 500 rupees per ton. Even Ultratech, the largest player, they have a reduction target of 200 to 300. This is essentially they essentially have a higher target for cost saving because of Adani's backward and forward integration capabilities. Let me illustrate this with an example. Let's say you are a milkshake producing company. You procure the milk from the farmer for 1 rupees and sell the milkshake for 2 rupees. So there's a this 1 rupee differential is essentially your EBITDA or your profits. Looking at it in a simplified manner, the milk producer, he'd produce a milk for let's say half rupees and sells it to you for 1 rupee, and his profit is 0.5 rupees. Now, if you, as a milkshake company, if you backward integrate and produce the milk yourself, you are essentially increasing your profit from 1 rupees to 1.5 rupees, as you also gain the profit share of the milk producer, and you procure the milk for free now almost. Since Adani has a captive coal mine and supply of fly ash from his thermal plants, he has ship and truck availability from his logistics arm. He will be a very backward integrated player and also forward integrated as well, as he owns some EPC companies that does civil construction work. So his demand is fairly ensured from that end. So this is a commentary from the various cement companies. Let's move on to the next slide. So why be bullish in the cement sector? If you see the variable cost of the cement industries, that is power and fuel, the raw material, and the freight cost per ton, it has increased from 2,400 rupees per ton in FY13 to about 4,000 rupees per ton. That is almost an increase of 70-80%. And since then, the variable costs have tapered off a bit. So there is a consensus that it has largely topped out, and it will be a downward hill from here, the variable costs. And if you also look at the price per bag or the realization, it is also at a very low point if you take the last 4-year comparison. and it is also showing improvement slowly. So we feel that the pricing also has bottomed out, and from here on it will be onwards and upwards. So yeah, these are mainly two reasons. One is a decrease in costs, and other is an increase in the price of the cement per bag. So, yeah, let's move on to the next slide. So if we see the EBITDA per ton for large players, it has been very cyclical. That is because mainly because of the crude prices, and also has been largely flat. But increasing share of green energy and more stable demand in the next cycle might ensure that we can achieve an EBITDA per ton of at least 1,400 to 1,500. So now, if the company such as Ultratech or Adani does cost cutting of about 200 to 300 rupees, that is an instant increase of EBITDA per ton to 200 and to more than 200 to 300 rupees. And couple that with the increase in realizations, it might even go further high. So this is the outlook for the medium term. So let's look at why should there be a price increase. If you look at cement industries, essentially their cost of setting up a capacity, the dollar per ton is almost 90 rupees, $90 per ton, which translates to rupees 7,200 per ton. So take the capacity to be 1 million ton, a hypothetical scenario of a cement mill, and is running at a utilization of 80%. And here the EBITDA per ton is 800. So essentially, when you adjust it for utilization, 80% of 800 is 640. And when you take out the depreciation and the tax, you get a EBIT post tax of 270 rupees. So this 270 rupees on an 7,200 rupees investment per ton essentially yields a return of capital employed of 3 to 4%, which is far lesser than a fixed deposit. So why would a cement company invest in a cement capacity when it can rather invest in fixed deposit and earn a return of 8 to 9%? So this is essentially the argument as to why the pricing needs to improve from here on, and why essentially why the pricing needs to improve from here on. Let's move on to the next slide. So this is also essentially the same as a previous slide. So for a greenfield capacity, the price hike which is required is 15.2% to earn a return on capital of 10%, which is actually lesser than the cost of equity. The cost of equity is 12%. And the price hike required for a brownfield capacity, greenfield capacity is essentially the capacity which you build from ground up. So it has a high gestation period of 3 to 5 years and higher capital expenditure of, yeah. So for brownfield capacity, which is essentially you expand the capacity in your existing plant, the price hike required is 5% to earn a ROCE of 10%. So let's look at this diagram. So to attain a minimum ROE of 12% on a capex of 8,000 rupees, you need a EBITDA per ton of 1,400 to 1,500 rupees. So the EBITDA per ton needs to be close to this range, this box, to be profitable in your investment, which now the industry is trading way below this mark. So you need to have increase in prices so as to sustain a good ROE, so that the companies can make stable returns from the investments they've already made. There's a Dalmia Bharat management, the last con call, they also mentioned that at current prices, no further investments in cement can be justified, and whether it is inorganic or organic. And so he also feels that the prices have to go above the current levels, and if it remains at the current levels, structurally it is not possible for the cement industry to sustain. Yeah, so these are the comments from the various management, essentially echoing what I said in the previous slide. And they also feel that the prices have been showing a steadier and better trend. Sorry. Let's move on to the next slide. So, if you see in the past 10 years, the top five players' share of the cement industry's capacity used to be sub 35%. There has been a rapid consolidation in the industry, M&A activities, which has led to the top five players' share in the total cement capacity being more than 55%, being more than 50% in FY24. So this rise has been exponential, and this rise will also lead to better pricing scenario in the cement industry. Yeah, let's move on to the next slide. Yeah. So this is what we were talking about in the South Indian market. The South Indian market essentially was very fragmented with more than 20 players operating in the market. And the top five players market capacity market share was around 30% in FY24. And since then, rapid consolidations have taken place. Lots of deals have taken place in the southern market. Now the share of top five players in the South Indian market is essentially 60%. So it has doubled in the past year. So this will lead to more stringent pricing, more stable pricing in the southern South Indian industries, which is very much required for this industry. Let's move on to the next slide. So yeah, the cement industry saw a geo moment in FY22 when Adani acquired Ambuja Cements. So essentially, what happened in the telecom industry when Jio launched in 2016, they offered way more for way less prices, which led to a lot of inefficient players either going bankrupt or out of business or being acquired by the larger players. So that is essentially what has happened in the cement industry post Adani's entry. Ultratech and Ambuja, they have led the acquisition spree over the past decade with Ultratech acquiring about 73 million tons capacity and 31 Ambuja acquiring about 31 million tons in grinding capacity over the last decade. So this M&A led consolidation has been going on because players they are pursuing larger scale and immediate access to the market versus if you set up a greenfield capacity, it has a gestation period of about 3 to 5 years, as we spoke about before. And also, they have access to a lot of surplus land and quality limestone reserves. The top two players, essentially Ultratech and Ambuja, they have been the key drivers in the acceleration of M&As in the past 2 years. And we see the speed and M&A in the past 2 years also has weighed on the balance sheet of the top two, with the significant exhaustion of their cash positions. So while we do expect the consolidation to remain a theme for the next 2 to 3 years, the pace may be slower than the past 2 years. Given the acquirers also need to prioritize stabilizing their acquired capacity and owning a good and earning a good ROE on their prior investments. Further, in some markets, even the top two may also start facing competition, CCA or competition issues for the further acquisition of assets. Let's move on to the next slide. This has been the largely the acquisitions which has happened in the past. A lot of uncompetitive players have been acquired in the past because of let's say bad burden, bad asset quality. So not bad burden, debt burden, the asset being distressed asset. They have not invested in modernizing the asset, and it remains a legacy plant, because of which they have higher costs than the new modern plants. A lot of factors go into why a promoter sells, which we'll talk about later in the coming slides. So limestone expiries also can be an issue in consolidation happening in the next 2 to 3 years. It has limestone mine ownership after there was an there was an enactment of an act called MMDR, which essentially stands for Mines and Minerals Development and Regulation Act in 2015. So what it essentially says is that any new player who wants to acquire a limestone asset, they have to acquire it through the auction route, versus earlier wherein it had been allotted by the state government. So the average royalty per ton on limestone can be a lot incremental once these expiries come in place. So it can range anywhere between 2x to 3x for the new mines which has been auctioned post 2015. So accordingly, new players they are unlikely to generate even the minimum required returns, and it will also act as an entry barrier for the sector. If you look at JK Lakshmi Cement, 82% of their limestone mines are coming in the expiry in the next 5 years. About 82%, that is a huge number. And we look at ACC also, they are about 53% of their limestone mines are coming to expiry. But ACC, they have the support of their parent company, Adani, so they might weather the storm. Nuvoku and Shree Cement, they are fairly well placed with only 2 and 3% of their limestone capacities expiring in the next 5 to 10 years. So yeah, limestone expiries also can be an issue. So if we see, a lot of cement mills are in the sub 10 million tons per annum bracket. So these companies, they come under the risk of being acquired by a larger player. So what might promote an owner to sell a business? Decades ago, the cement industry they attracted a lot of investments on because of limestone allocations to a certain set of promoters. So the cement business is also a good cash flow generating business once the capacity is stabilized. That factor also enticed a lot of promoters. But the scenarios over time has changed a lot. Since 2015, as we spoke about, limestone mines are getting auctioned, and some are getting through at a very fairly expensive premium to the base price. And yeah, some other reasons for promoter selling might be cornering of profits by the top players and increasing competitive intensity, implying that the returns may not be remunerative for smaller inefficient players. Another factor might be maybe the next gen. There is no next gen, or the next gen of promoters are not confident enough to take on the business to the next level. So example of such a acquisition is India Cements recently when Ultratech acquired. So there was no next generation of promoters looking to take the business forward. And yeah, and limestone expiry could be a reason. Leveraged balance sheet could be a reason. Or if it is a group company which is in multiple set of businesses, and cement is a relatively lower focus segment for them, that might lead the promoter to hive it off. For example, when CK Birla sold Orient Cement to Ambuja, that was because they had lesser focus in the cement business, and it was also not very ROE accretive for them. So yeah, these are some of the reasons why cement mills come into the acquisition radar by the bigger companies. So the valuation of the cement companies. This is the internal exercise we did to value all the cement companies. So Ultratech, it is having a capacity of 117 million tons currently. So if we take the replacement cost of 1 million ton to be 800 crores, so the replacement cost of Ultratech comes about 1 lakh crores. But currently, it is trading at an enterprise value of 3 lakh 66,000 crores, which is a premium of 266%, which is not inexpensive. It is trading at a very high premium to the replacement cost. And the enterprise value to EBITDA is also trading at 30x. Historically, for a company with a low ROE profile, 8 to 12% ROE, 30x is very, it's not cheap. If you look at Shree Cement also, it is trading at a premium of 137% to its enterprise value, to its replacement cost, sorry. And CV to EBITDA is also 29x. Ambuja Cement is a little bit better price than the other two players. It is trading at 73% to its replacement cost at a premium of 73%. And EV EBITDA is at 24x. This discount maybe we can attribute it to the factor of the promoter risk, essentially, which the market is factoring in. So yeah, whether it is justified or not, I leave it up to you. So that might be the reason why it is trading at a reasonably lesser valuation compared to the other two companies. Dalmia Bharat, they are trading at a reasonably better premium to their replacement cost. This is because South and East market, South known for its, as we talked about, is known for its very bad pricing. South and East, it contributes 70% of their capacity. So that is the reason why the market is pricing in a lower EV EBITDA for the company. But they target to reach 75 million tons by FY27 and 10 million tons per annum by FY31. Which also carries a steep execution risk, and they've faltered on their execution in the past as well. And the entry of Adani and Ultratech into the southern markets, it might increase the competitive intensity for them. So this is why Dalmia is trading at a cheaper valuation. But if you have a contrarian view that they should do well, Dalmia is a good company to look at. Let's move on to the next slide. So we, as a house, we expect the larger players, not the stock. When I'm not talking about the stock performance, I'm talking about the company. So the larger players should do better, guided by their scale, their diversification, their growth pipeline, their aspirations, their incremental possibility of ROI generation, and also, yeah, the ROE generation. So typically, larger cement companies, they are associated with a diversified or a pan-India presence. So this results in lower earning volatility. Let's say it is Ultratech is present in all the five key markets in India. So when southern market is facing a downturn, it will be counterbalanced by, let's say, the east market growing at a higher rate. So the earnings volatility will be little more subdued for the larger players. Yeah. So let's move on to the next slide. So this is a sell side report by Spark Capital. If we look at Ultratech Cement, they expect their market share to go from 28% to 38% by FY26. and Ambuja Cements to go from 14 to 17%. So essentially, the two players will almost control 50% of the cement capacity market, which is actually huge. So it should lead to better pricing discipline here on. And also, yeah. And if we also look at the other players, their share is set to reduce from 34% to 26% in this 2 years. So a lot of uncompetitive players are expected to get out of the market. So this is largely the expectation, our expectation. And yeah, so that about wraps up the webinar. I hope it was useful for everyone in understanding the cement industry better. And I also thank everyone for allocating your time to listen in, and hope you have a wonderful day. Thanks a lot. Yeah. So I think we can wrap up the webinar.